Hey Bowtie Nation, Joseph Hogue here with some huge news out of Alibaba today that the company will be splitting up into 6 independent companies. We've been talking a lot about spinoffs lately, a lot of companies going through these. We've seen these typically outperform the market by as much as 30% over the year following that spinoff. I want to do a quick valuation of shares of Alibaba, show you why I already own the stock and why my price target just went up 20% on this news. So excited about this. I didn't even shave it yet this morning. I wanted to get this out and show you the upside in this stock. Now first, how this is going to work is Alibaba reports 7 business groups in its financials. China e-commerce, international e-commerce, food delivery is what is called as local consumer services here. It's a Cainiao, and I know I'm mispronouncing that right, but the Cainiao Logistics unit, cloud services, digital media and entertainment, and then this innovation initiatives. So the plan here is to split into 6 independent separate companies in each of these segments to seek an IPO on its own. It's going to be China e-commerce, which will stay under the Alibaba group, international e-commerce, food delivery and digital mapping, logistics, cloud, and then digital media and entertainment. Each of these segments is going to continue to operate under that parent company, but then seek an IPO of the shares when possible. So only the Chinese e-commerce and cloud segments are profitable right now, though I do think that international e-commerce, logistics, and digital media are going to be profitable within the next year and could seek an IPO very quickly. So you're going to see a very quick breakup of this company. And here, what I want to do for this Alibaba valuation is what's called a sum of parts valuation. That's going to break the company into those 6 segments, comparing the current revenue, the growth, and valuation against similar stocks, how those stocks are trading in the market, the valuation for that. And with that, we can add up that standalone valuation to see how it compares against the current valuation of Alibaba. I'm going to show you why that's important, but first, I want to personally invite you to get the Weekly Bowtie, our free weekly newsletter with all the stock market news, strategies, and trends you need to know. Each week before the market opens, I'll show you what I'm watching and the stocks that could highlight the week. It's all totally free, just something I like to do for all you out there in the community, so look for that sign up link below. And we see this kind of sum of parts valuation a lot with these conglomerates like this because there is a conglomerate discount. Okay, shares of these big hodgepodge companies like 3M, like General Electric, like Alibaba that have so many disparate business segments, they trade at a discount to the what would actually be separate companies because investors just have less faith that each segment can operate on its own very well under a bureaucracy. Okay, managers within each of these segments have to go through those mountains of red tape to get their projects approved, and valuations are just consistently lower than if each segment were allowed to run as a separate business. In fact, we've seen shares of General Electric jump since its spinoff announcement. Shares are up 68% since that September announcement, and here we see in this chart, just since the January spinoff, shares of GE are up 42%, and the new GE Healthcare is up 31%, and that's against a stock market that has gone nowhere but down. I'll be using Alibaba's recent quarterly earnings to estimate the valuation for each business group here. Company-wide, Alibaba did report 660.5 billion renminbi in sales over the 9 months through December of last year. That is about $95 billion over those 9 months. If you want to get to renminbi to US dollar conversion, you just divide the renminbi by 7. It's actually about 6.96. It's about a 2% growth year over year as China really kept those pandemic lockdown restrictions in place. But we are expecting growth to pick up now that China has removed those pandemic restrictions and for growth to really accelerate into this new year. Now, an important note here for this Alibaba valuation, while I am expecting that sales growth, the economic growth in China to accelerate here over the next year, we remember when the US removed its pandemic restrictions, a lot of that revenge spending by consumers, stronger economic growth. We are expecting that in China over the next year, but I'm not going to be doing that. I'm not going to be estimating future revenue and what it means for the stock price. For this sum of parts valuation, I'm going to be seeing how much each of these 6 separate businesses should be worth over the current stock price. So I'm just going to be looking previously at their own revenues, how much they should be worth if they were separate companies, not how much it's going to be worth in the future based on that company growth. I'm not trying to predict the future here. I just want to see how much the shares of Alibaba should be worth with 6 separate companies instead of all one big conglomerate. We do see shares of Alibaba up already 11% on this news today. I'm going to show you why it should be worth even more than that. But if we go to statistics here in Yahoo Finance, we can see that the current price to sales valuation for all of Alibaba, those 6 groups together, is about 1.7 times on a price to sales basis. Now that is well below 2.4, 2.5 times price to sales it traded at just over the last year. So you could make a case that the shares should be higher already on that higher valuation, but we're going to go with this 1.7 times price to sales valuation for the group as a whole. Now that's actually pretty close to the valuation on Amazon right now, very close comparable with Alibaba on those different business segments, but Amazon trading at 1.8 times on a price to sales basis, about 8% year-over-year growth in sales right now. Frankly, I think both of these stocks are terrifically undervalued. I own both of those shares, but we're about to see how much of a boost shares of Alibaba could get just on this split. So looking at these separate business segments, we're going to start off with the China e-commerce segment here at the top. It was down 1% on that 9-month year-over-year basis to 446 billion renminbi. It's about $64.2 billion in US dollars in the 9 months to December. That's 68% of the total revenue here. So this is very much most of the company right here. I'm estimating full year segment revenue of about 85.3 billion. If we scroll down, we can also see the profitability for each of these business segments. China e-commerce here is the strongest earnings profitability of the group with 34% EBITDA margin. That is earnings before interest, taxes, and amortization. So that's basically your basic earnings profitability, the 34%, very strong. And what I want to do here, again, with this sum of parts valuation tool, we want to look for other companies that are more focused in each business segment to get a comparable price to sales valuation that we can then apply to Alibaba's different business segments to see how much each segment should be worth in the market right now. For that, we're going to use PDD Holdings. That's that Pinduo. They're much more of a China e-commerce play than Alibaba with the broad disparate groups. So we're going to look at the statistics, the valuation here for PDD Holdings, and we can see that PDD right now is trading for 6.6 times on that price to sales valuation, very much higher than overall Alibaba valuation. That does have 28% growth in sales, annual sales here for PDD, so that is quite a bit higher than than pretty much flat sales growth or 7% expected sales growth for the China e-commerce segment of Alibaba. So I wouldn't expect it to get to that kind of 6 times price to sales valuation, but I would expect it to get closer to that 2 times valuation price to sales and be worth probably close to about 171 billion market cap for just the China e-commerce segment. Now later on, I'll show you a table with all 6 segments, the valuation expected for each, and what that means to the overall stock price, what kind of an upside you can expect from that. Here, I just want to go through each segment really quickly, compare it to another stock in the market to see kind of what each segment should be worth. Here in the cloud segment, we did see 5% year-over-year growth to about $8.42 billion in sales for the 9 months to December. That's about 9% of total revenue sales, and I'm estimating full year segment sales here about $11.5 billion. The cloud segment is the only other segment besides that main China e-commerce segment that is EBITDA profitable right now. It's got about a 2% profitability margin, but I do expect a lot of these other segments to become profitable over the next year. With the cloud segment, it's really hard to find a pure play cloud company comparable for this because most other cloud services companies have a lot of other services built in. You think of companies like Microsoft really leading in the cloud with their Azure service. Think of Amazon Web Services, that AWS cloud, really leading that group, but it's all within those big conglomerates. Here we're going to use CRM, that's Salesforce Inc., for the most direct comparison I think we can find on just a pure play cloud services company. Here we can see CRM trades for about 5.9 times on that price to sales valuation. There's also another company a little bit more focused towards cloud services called Instructure Holdings. That gets about 7.3 times on that price to sales. I'm going to go with a lower 5 times valuation for Alibaba just for conservatism, just to keep it very conservative on our estimates, and go for about a $57.5 billion market cap just for Alibaba's cloud services segment. Here for international e-commerce, we did have 8% year-over-year growth here, so very much stronger as Alibaba expands overseas to $7.3 billion. That's about 8% of the total revenue for the company. I'm estimating full year segment revenues here about $10.3 billion. Now the global e-commerce segment is operating at a slight EBITDA loss here, about $109 million in the most recent quarter. It's about a negative 4% EBITDA margin. but it could turn profitable here over the next year with that 8% year-over-year growth, and I think even stronger as the global economy eventually starts to pick up. I think this global e-commerce segment should be profitable very quickly. For the global e-commerce segment, again, it's difficult because a lot of these, like Amazon here, probably one of the best comparisons you can make is very much a conglomerate itself. So if we see a 1.8 times price to sales valuation on shares of Amazon, it's because a lot of these other segments and that conglomerate discount is probably pulling that down. If we look here at Mercado Libre, which is much more of a pure play e-commerce play, and we look at its valuation, we see that it is trading for about 5.7 times on a price to sales valuation. So very much higher valuation than Amazon or Alibaba, but it does have 24% year-over-year sales growth. So a little bit higher valuation would be expected there. I think the global e-commerce segment for Alibaba is much more comparable to Amazon as far as that growth. So I'm going to go with a little bit lower 2 times price to sales valuation. Now, both of these should be higher. Amazon traded for as high as 3.5 times on a price to sales in 2019. So very much higher than it is right now. For Alibaba, for this segment, I'm going to go with that 2 times price to sales valuation and a market cap of $20.6 billion. For Alibaba's food delivery segment, what it's calling its local consumer services here, we did see 11% year-over-year growth. So one of the stronger segment growths in the group here to $5.4 billion. That's about 6% of the total revenue, and I'm estimating about $7.7 billion full year. Within the food delivery segment, they're also adding in this digital mapping services, which is part of their innovation initiative segment, a very new segment, very much unprofitable still. Did report $245 million in revenue over the 9 months to December, so it is performing. I'm estimating about a $325 million full year for this group, but it's really negligible as compared to a lot of these other segments. But it is going to be added to the food delivery segment when it eventually splits apart. Now, profitability for the food delivery segment, which is still newer than a lot of these others, still operating at a negative 24% EBITDA margin. They lost 9.8 billion renminbi over the 9 months to December, though there is an improvement from a loss of 16.5 billion in the year before. So that profitability or that growth in year-over-year sales is following through into profitability. I think it's likely a couple of years out from a spinoff, so this is probably going to be one of the last parts of the company to be spun off from Alibaba into its own separate group. The most direct comparison we can make here is DoorDash, that's ticker DASH. We look here in here statistics and see that it is trading for about 3.4 times on a price to sales basis. That is on about 20% year-over-year growth though, so not quite the growth there we see in Dash for that food delivery segment of Alibaba. I would go with maybe a strong 3 times price to sales valuation for that segment of Alibaba, maybe a $24 billion market cap. In the logistics segment, what Alibaba reports as Cainiao here, very strong sales growth, 22% year-over-year sales growth to $6.1 billion. It's about 6% of the revenue, but obviously growing fast with that kind of growth. Estimating about $7.8 billion full year. This segment lost just $1.7 million last quarter, and we're really with that strongest sales growth of the group. It's going to be profitable inside a year, and I think one of the quicker ones to spin off from Alibaba. Now, we do have a Chinese logistics company comparable here. It's SF Holdings, trading for about 53.5 renminbi per share. That'd be on about 42.4 renminbi per share in revenue. It's about a 1.3 times sales price to sales basis, and it's got comparable growth with that logistics segment of Alibaba. With the U.S. comparable, I'm going to go with UPS here. That is trading for about 1.6 times on a price to sales basis, but does have single-digit sales growth, so quite a bit slower than the sales growth we see in Alibaba's logistics growth. Here, though, I am going to go with a 1.5 times price to sales valuation for that logistics segment of Alibaba. We do see a discount to Chinese valuations comparable to U.S. companies. If you just directly compare them from company to company, there is a price to sales, price to earnings discount when you look at U.S. companies versus Chinese companies, just because of that geopolitical risk that investors have to take beyond just the business risk. So that would mean a 1.5 times price to sales valuation, mean about 11.7 times billion market cap for that logistics segment. Finally, on the digital media and entertainment segment of Alibaba, then I'm going to show you this full sum of parts valuation. There was a slight 4% drop in revenue over the 9 months to $3.3 billion. It's only about 3% of the total revenue of the company. I'm estimating about $3.8 billion in full year sales, and this is probably one of the ones that is going to see a very strong pickup over this next year with the Chinese economy. This one is also very near profitability with a loss of just $3.6 million reported over the last quarter. I think with that revenue growth, especially with the Chinese pickup, this one could become profitable very quickly and have a spinoff over the next couple of years. I think the two best comparisons here for that digital media and entertainment group, probably Disney Company, the Walt Disney Company, ticker DIS, and Tencent Holding Limited, that's ticker TCEHY. With Disney, you see trading at 2 times on a price to sales basis with about 7.7% year-over-year growth. Tencent Holdings with a little bit faster growth, 11% year-over-year, and that growth in revenue, trading for about 5.3 times sales. And again, just to get a conservative estimate here, I'm only going to go with a 2 times price to sales valuation. I just want to get the base estimate for how much these segments should be worth above what the overall company is worth right now. Not going to try to shoot the moon on this. I just want to get a very conservative estimate of valuation. That 2 times price to sales estimate would be about a $7.6 billion market cap for this digital media and entertainment segment. So here we see a summary of that sum of parts valuation for Alibaba. I've listed the estimated full year revenue here for each segment, as well as that price to sales valuation that I'm going to be using, and an estimated market cap of the segment once it's split off in an IPO. And you can see the sum of each segment gets us to just a little over $292 billion market cap. That's about a 21% higher than the current $242 billion capitalization and the $94 share price. In fact, it actually gets us to a stock price for Alibaba of $112 per share. And remember, that is not a target share price, but just how much these 6 separate companies should be worth right now, 21% higher than the current stock price. With that reopening growth we're expecting in China now that the lockdowns have ended, I bought shares of Alibaba over the past few months, had a price target of about $150 per share at least, even before the split announcement. So add this onto that with this announcement, I think they could go to $180, $200 very quickly within the next couple of years. Click on the video to the right for the 7 penny stocks I'm buying right now. 7 stocks under $5 each for 10x returns. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.